Welcome back to Real Estate Syndicator Live, episode 17. And no announcements today. I want to make sure that we get maximum value and maximum time with our amazing guest today. Brandon Turner probably doesn't need any introduction, but nevertheless, I will give my my obligatory intro.
I just like my ego stroke, so let's hear it. Come on.
That's what I figured. Most of you guys obviously know Brandon as the former now co-host of BiggerPockets podcast, the biggest podcast, real estate podcast on the planet, obviously. But probably less people know that you're actually probably one of the best real estate syndicators on the planet, in addition to being one of the top real estate guys, being a best-selling real estate author. And how many books do you have now, Brandon? I've lost track.
I lost track. Five or six or something.
I know him more as the managing member of Open Door Capital, which is a real estate company. He syndicates over, I think, $375 million in assets under management, over 5,500 units spread across mobile home parks and multifamily. So I know that two asset classes that you're well known for. So anyway, buddy, really, really appreciate you taking time on behalf of the entire community. So welcome to the beard.
Yeah, thank you very much. And I'm in Hawaii right now. So if my internet gets wonky, just tell me to repeat something. Cause I don't know, a whale will hit the undersea cable and it messes up our internet. So it's one of the many downsides of living in paradise.
Did you officially change the name of your shed to the Love Shack or anything like that? Are we still calling it the shed?
It is the sea shed, the sea shed by the seashore, because I can literally see the ocean from right here. I see it.
That's awesome. That's awesome.
Not a bad spot.
A great little thing. Hey, guys, as always, just put your questions in the chat, and then I don't know if Bethany's in France or in London. She got COVID too, by the way. So we both got COVID at the same time, she's on vacation,
I don't know how I didn't get COVID. I mean, I shook 4,000 hands at Limitless, and then went to Boise, and then I went to San Francisco for an event, and I talked to everybody, and I was like this close to everyone. I didn't get COVID. Yeah. You show up for a day and you got COVID. I don't know. I'm a miracle child.
A miracle child. Hey, Brandon, I'm going to ask you to retell a story I'm sure you've told 1,000 times, but I love the lesson behind it. We talk a lot about in the community about, adding value, whether it's to your investors or whether you're, marketing, whether you're trying to establish, substantive relationships, all that kind of stuff in the syndication world. But you want to tell briefly your story about how you even got involved and how you met Josh and how you got involved in the BiggerPockets podcast. I think there's a great lesson there, and that'll also kind of warm people up and have people drop the comments in the chat. We'll get right to those after this. I think it's a great lesson, Brandon. Do you mind resharing that story?
Yeah, there's actually a few cool lessons in there of how I got into the BiggerPockets world. So let me start before that. I was buying real estate, houses, single family, duplex, that kind of stuff. I was flipping a little bit, and I was generally not that good at any of it. What I mean by that is this is 2008, 9, 10, 11, 12. I'm just trying to hang on, right? Doing a crumbling market. But I ended up acquiring 30 rental units. And that was my goal. I said, I want to get 30 units making $100 a month, because I knew that if I could just get that, it would cover my bills and I'd have financial freedom. And so I did. I went and got 30 units, and I actually used BiggerPockets for advice through the entire time. So I didn't start BP, I came later, and I used it the whole time. So I got to know who Josh was. He was he was the founder and the only guy that worked at BiggerPockets. So I learned about BP. I used the forums. I was one of their early members. And then at 27 years old, I had financial freedom. So I quit my job and I sat on a couch watching TV, Judge Judy and whatever every day for a few months. And then I realized that was really boring, needed to do something more. So I started kind of an online website called realestateyour20s.com, which I was going to teach young people how to invest in real estate, like what I did. And in that process, in order to grow your blog, the best way to do it is to go to somebody else's blog and post on their site. We call them guest posting, right? So I went to Josh. I was like, hey, can I post on BiggerPockets? You're a much bigger site than me. And he let me. And so I started writing these little articles here and there. And then one day, Josh says on his Facebook page, I'm looking for someone to help me edit blog posts. And I was like, I speak English. I can do it. The truth is, no, I couldn't do it. I was a terrible, terrible editor. However, I ended up talking to Josh and I was like, yeah, I'll do it. But here's the first lesson that I always want to throw out there is I don't think I would have been able to take that opportunity had I not already had some financial freedom. And so the point, it's kind of like the Robert Kiyosaki, cash flow game, right? I was in that rat race, but once you get out of that rat race and you have a little bit of money coming in, you can take bigger risks to do some really cool things. Josh couldn't pay a lot of money in the beginning. So most people wouldn't have taken that job because they couldn't afford to take the job. So lesson number one that I can throw out there is like, I could take the opportunity because I had some level of like baseline financial freedom. So anyway, lesson number one there. Number two, again, I didn't know how to edit blog posts. I can barely spell there, and there. Like I'm like, but I just knew if I could get in Josh's world and provide value there, besides making a little bit more money, he was going to pay me something to do this. But besides that, like I would get in his world, and I knew that like he would be a valuable person in my life to know, because he was such a connector and he knew a lot of people in the industry. And so, yeah, I just started editing blog posts for him. And then one day we were like talking, and I said, hey, I've been doing this thing lately. It's kind of weird, but like you put on headphones and walk around and listen to people talk. They call it a podcast. And Josh was like, that sounds like witchcraft. I'm like, no, it's really cool. And so we ended up starting this podcast, and it took off. And, you know, the last lesson I'll throw out there is, and this just applies to everybody. Like, I did not make BiggerPockets grow. Like, it wasn't branding coming on that made it shoot up. What it was that there are certain things that every business owner knows they need to do over and over and over and over. And it's usually pretty boring. And so they don't do them, right? Whether you're a real estate investor, you got to analyze deals and make offers. You got to network. You got to do these things that you have to do them over and over and over for 6 months or a year straight. So what really happened is Josh just hired someone to do the boring tasks. So those tasks got done. I wrote 100 guest posts for other websites that first year that all pointed back to BiggerPockets, which helped it grow. That wasn't like I was the muscle, but it was like Josh's idea of let's get somebody else to do the boring work that matters. So the reason I say that is because I want to encourage people in your own business. What is that thing that you could do if you did it every day for the next 6 months would almost guarantee the results that you're looking for in life? And then the second thing is like, who are you going to get to do that? Because you're not going to do it. I'm not going to do it. Like, we're entrepreneurs. We don't do that stuff. Exactly. So like, who can you get to do the boring, mundane tasks that probably isn't that boring to them? And that's what you're going to watch your business explode, which will happen to BiggerPockets.
And isn't that now you kind of carried that over to your real estate business? Like, most of the people that really are on your really executive team, people kind of high up there, they all started as like interns.
Yeah. Everybody started the same way as I started with Josh. It's like some kind of volunteer basis or some way. Because I'm such a big believer. You never know how someone's going to be until you work with them. Like, resumes are just lies, and like interviews suck. Like, they all, like, you never really know, right? I mean, everybody hire people before you realize that, like, sometimes it's just a gamble. Yeah. And so I'm a big believer, and Josh was too, in finding out if you work together well and if it's the right person by working together before you like commit. Like, in other words, date before you get married. And so like I dated, like I've had dozens of interns over the years, and a few of them have risen up and now they run the company. Yeah. And it's been remarkable.
Yeah. And I know we're both big Gary Vaynerchuk fans, and his big quote is, hiring is guessing, firing is knowing, but hiring is guessing. So
I not heard that. I love that.
That's a great quote. All right. Well, actually, I'm glad I just saw Frances come in, who I know she's got one of the questions, but before we go in there, I know there was a lot of questions, and I'll start it off with this question. I can already see a bunch of questions here in the chat, but everybody's looking for, not everybody, but there's a lot of people who are at different phases of raising capital. Like, some people are experienced and they've been doing it for a long time. Some people are just starting out. Some people haven't even started yet. They're really looking, and they're always asking, what's kind of the best practices that you employ, Brandon, in raising capital in Open Door Capital these days? Is there some kind of technique or philosophy or overarching theme in terms of your approach to raising capital?
Yeah, I love that. So in my opinion, raising, like, let me go with this. Real estate investing as a whole is a very mechanical business, meaning like you just do things and it produces the results you want. You make more. If you want to buy more deals, you make more offers. That's how some people are buying 1 deal a year. Some people are buying 50 deals a year. The 50 people a year are just making a lot more offers. So most real estate investing and syndication and all that is very mechanical, and you can turn it up and turn it down at will. The two things that require something special, I would call it is likability, or you could call it trust. Like, someone knows, likes, and trusts you. That is a thing that's not necessarily, you can't just turn it on and turn it off. Like, you got to be good at that. And the second thing is the size of your list, right? So in other words, you have to get people to know you, and then you have to be able to get in touch with those people. Everything else can be dialed up or down based on those two things. In other words, if you have 10 people in this world that have money and like you and trust you, and you can get in touch with them to tell them about a property you have, like, you could buy a certain number of real estate deals every year, or maybe like one apartment or one small thing. If you have 10 million people who know, like, and trust you, and you have their phone numbers and email addresses, can you do a lot more real estate? Everyone here is saying, of course, yes, because those two factors, the likability factor and your ability to contact those people are the biggest thing for a syndicator. I wish somebody would have just hit me upside the head and told me this 10 years ago. I would have started building my list years earlier. Like I didn't really start building a list of emails until like a year and a half ago, 2 years ago. And yeah, we scale based on the size of our list. And it's like, I heard this stuff for years in internet marketing. Like I knew that you should build your list. It never occurred to me to apply that to real estate investing, because oftentimes, at least this is for me, maybe not other people, I'm slow and dense sometimes. Like I didn't realize real estate was a business. Like that sounds ridiculous, right? But I didn't realize that real estate investing is a business, just like owning a blog, just like owning a McDonald's or a Pizza Hut. It's a business. And when you start operating on business fundamentals, like grow your list, like it scales like a business should. It's phenomenal. So yeah.
And I know you use the medium, obviously, of podcasts, and obviously not everybody is the co-host of the largest real estate podcast on the planet.
They could be.
They could be. But for the mere mortals among us, are there things that you would be, if you didn't have the podcast this way, if you didn't have the podcast, how would you go about building that list and adding value to that list and getting people to like you?
Yeah, man. There's a number of ways, right? Like my skill set lies in podcasting. That said, if you go back and listen to the first 100 episodes of the BiggerPockets podcast, I don't think anyone would listen to that and go, "Oh yeah, Brandon's skill is in talking." Like it was like I was not good at podcasting until years, and I did not have this energy or this persona. My first episode, I'm like, "Hi, Josh, how are you today?" And he's like, "I'm good, Brandon." Like we were terrible, right? So number one, you can learn anything. Don't tell yourself a story that you're not good at something. No one's good at something in the beginning. I did not develop that like immediately. It was over time. The second thing though is if that doesn't fire you up though, if like you're really like, I don't want to be a YouTube guy. I don't want to dance on TikTok and point to random pieces of the screen hoping words pop up. Like I don't want to do that stuff. That's cool. There's a million ways to build your what we'll call personal brand out there. I mean, like I know guys who write blog posts, just really good, meaningful blog posts, or they post on LinkedIn. Like our friend Leica just posts really meaningful content on LinkedIn, and then people follow her, and then they like her, and they trust her, and they get in touch with her, and she has their email, and then she raises a bunch of money from it. It's like, whoa, it totally works that way. So it's like you pick the thing that you're good at. Now you could go the old-fashioned way. If you really don't want to use this whole like internet-y computer thing, you can just go to meetups and meet with people and get them to like you in person by shaking their hand and talking to them and asking them what they're doing and then writing down their phone number on your piece of paper in your pocket. Like you don't have to use the internet, but man, I tell you, like the internet makes things 100 times faster, easier, and just better. So if you can find a way to use some medium out there, there's something that you could do, I would do it.
Great advice. I couldn't agree with you more. All right, well, let's get to some of the questions, Brandon. I'm going to give some priority to folks who submitted questions ahead of time. But Alec, I don't know if you're Alec Beardall. Are you in there? If you are, just unmute yourself. No pun intended. Beardall. Look at that, Beardall. Alec, are you here? If not, I'll ask your question. But I know you had a question specifically about systems and things that Brandon uses.
Yes, I am here, but I'd love if you just would ask it.
All right. Well, the question came in now, Brandon, I don't know if you've ever, all the ones we've done are 506C deals, so you don't usually deal with non-accrediteds. But Alex's question was, how do you go about acquiring new investors? We talked a little bit about that just now, especially on the 506B side. What systems, products, and resources do you use to be such a phenomenal capital raiser? Look at that.
Well, thank you for the compliment in the question. I like that. Let's see, a couple of thoughts. Number one, again, going to conferences has been such a major piece of my life. Like when I go to real estate conferences or any conferences, like it's been such a powerful thing. So, I mean, I probably have, I don't know. I'm like, I don't do a lot of 506B collection. I haven't been focused on that. But if I had to right now, I could probably name 100 people I could go to for a 506B raise, and I'd probably be able to raise a ton of money that way. I mean, we're only capped at 35, right? But or whatever the number is. So like, I wouldn't be able to use that. Like I have them just from conferences and networking events. Like for example, like being in the Maui Mastermind, which Mauricio, you're in, or GoBundance. I'm a part of the GoBundance tribe, or I've been in part of other like groups before in the past, where we just hang out together sometimes. And when you hang out with people and you do it in a big group and you're at a conference or whatever, you just get to know people. And the more you get to know people, the more you find out what they have and what they don't have. So a big piece for me is conferences and like those kind of masterminds. Like I will pay to get into groups where there's a lot of people that are where it's a target rich environment, as they say. And then also for like the kind of technology side of that, we track most of these people. We put them in, we have a project management software we use called Asana, ASANA. So we kind of like keep track of our list in there. I think we have also used HubSpot, which is a CRM. So we use kind of a combination of that. But honestly, you could just take a Google spreadsheet and just put people's names and emails and phone numbers in there. So that's a big piece of it for us, is just track, like getting those people in your world and then making sure that you're following up with them regularly, building that relationship, especially on the 506B side, because you've got to be able to establish that you have a real relationship with these people.
Look at
Can I
that.
answer that?
Yeah, you did. That was great. And thanks for busting out some illegal chops there.
That's why they call me the lawyer. Did you know? I was actually, yeah, you knew that. I was gonna go to law school. I took the
Yes, I'm so glad that didn't happen. Just for your sake, not just for your sake. Not that
I know.
Like, oh my goodness.
Oh, I'm glad I didn't go that route. I mean, you have to be a moron to be a lawyer.
I don't know. I got lucky. Francis, I think I saw you pop in. Francis, you guys are neighbors. Francis is a Hawaiian. There you are, Francis. Do you want to? I know you had a couple questions. We answered a little bit about the best practices, but you want to ask your question, Francis?
I would also, thank you so much, by the way, both of you. I would also love, Mauricio, if you ask it, because I know I wrote a couple questions in there and I think you have it in front of you. That would be amazing.
Yeah, I'm trying to get everybody some screen time here. That's right.
I had a very basic question that I will ask Brandon, and this is so simple, and I literally have researched this. I'm like, why is it hidden online and I can't find this information? When you raise for a fund, how are you paid out? Is it just that split? And what if you're doing a fund to fund? How are fund to fund raisers compensated?
Sure. I'll tell you what I know, because we've not done a fund to fund. So I'll tell you what I know and then how we're compensated, how I'm compensated. So and Mauricio, obviously jump in and tell me if I'm saying anything wrong here. You're smarter at this than I am. But so we typically do a 70-30 split. So in other words, the general partners, me and the rest of Open Door Capital, we take 30% of the the eventual equity, right? But also 30% of the cash flow. That's after the preferred return, which is 7 or 8% depending on the deal. So in other words, the first 7 or 8% goes to the investors. After that, from 7 to 15%, that typically gets split 70-30. And then after that, after 15%, we have a waterfall in that says it goes to 50-50. Now, we also get fees up front. So we charge, let's call it a 2 or 2.5. Let's just call it 2 for easy math. 2% acquisition fee when we buy a property. So if we buy a $10 million property, we're going to walk with, am I 200 grand? Am I doing that math right? So we get $200,000 as a fee. Now that money goes to fund my team. I don't really make much off of that. I give myself a small salary just to stay like, I don't know, whatever, I can pay the bills, but I have a small salary. But mainly like, I don't get the money there. I don't even get much of the money really like in the 70-30 splits, because most of it goes to the preferred return and gets divvied up with everyone else. Where my marshmallow is at the end. My marshmallows are at the end. And what I mean by that is, when I was a kid, I would eat Lucky Charms for breakfast, like all the time. It was my favorite cereal. And I would pour a bowl of Lucky Charms cereal, which is cereal and marshmallows. And I would eat all of the cereal first. I wouldn't touch the marshmallows, not one. And then I would pour another bowl on top of it. And I'd eat all those cereals, like not the marshmallow. And I'd do like 3-4 bowls of cereal. So by the time I was done with the meal, I'd have this pile of marshmallows, like the whole box of cereal, just marshmallows is left. And then I would just dig in. That's when I make my money at the end. Assuming these deals go right and we're able to take, let's say $1 billion, turn it into $1.5 billion, take that $500 million, investors are going to get probably, 70% of that, let's say. And the other 30% goes to the GP. I own roughly half, give or take, of the GP. So that's when I walk with hundreds of millions of dollars, hopefully down the road. So I'm getting my marshmallows then, but I'm having a great time along the way. So
yeah, no, that's and I think most people do it. It's a similar structure, Francis, too. So I mean, 2% acquisition fee is pretty standard, and then a 2% asset management's pretty standard, and then it's then there's a split, whether it's 20 or 30% of the carried interest, and you may or may not throw in a preferred return in there. And then it doesn't really change that much, Francis, on the fund of funds. I mean, people who do fund of funds, same thing. They're going to take a 2% asset management fee, and it's a 2 and 20. It comes from the hedge fund model, and everybody, we don't have too many people who are super creative, and so I think they just steal the 2 and 20 from the hedge funds. But great question. Mark, you've got a couple here, but I like this KPI. I don't think we've asked Brandon before KPI questions. So Mark, you want to ask your question about KPIs?
Sure. Hey, Brandon, we met in Massachusetts in March in
What's
the
up, man?
water park. How are you?
I remember. What's up, man?
I'm doing awesome. How are you?
I'm good. I'm good.
So I know I've heard you say multiple times KPI. So if I was only able to track 5 KPIs, what must I track to build a successful syndication business?
I love this question. All right. So this is off the top of my head, but if I was going to build a syndication business and I had to track like 5 KPIs, let's see. Number one, the size of my email list. Like I care a lot about the size of my email list. So that's a KPI I care a lot about. Number of offers made, number of deals analyzed in no particular order. So number of deals analyzed, number of offers made, size of my list. What else would I care about? Man, those are the big 3. Offers made, deals analyzed. I don't know. I'm just going to give you 3 because I really think like if I nail those 3, everything else just falls in place. I mean, I might have some like, for example, property management metrics. We have those. Like we need to make sure that we're hitting our projections. So we always have a goal for projections on the property management side. Yeah. So I'll give you those 4. I don't know. Anything, Mauricio, that you would say as a 5th?
No, I think you've got it. Plus my brain's so foggy right now. There's no way I can give you anything intelligent here.
Yeah.
You had a great question about the mindset, the mind. I love mindset stuff. So you want to ask me, that's a great follow-up too on the mindset shift.
Absolutely. Sure. So the next question was, what has been your biggest mindset shift for you and your company as you grew, and how would you compress the growth time if you were to do it all over again?
All right. Great question. Let me go back to the first one because I thought of one more KPI. It is my social media like number. In other words, like how many posts a week am I putting out? Because like that's the start of the funnel. So it could be blog posts put out. It could be LinkedIn comments. It could be number of times I commented on somebody's thing. But I would need some metric for the very first interaction people have with me. And then the list size and everything else. Okay, there's your 5. Let me go back to, so mindset shifts that like kind of helped me grow. Is that kind of the idea?
Yeah. What was the biggest mindset shift for you and your company? And then basically, how would you compress that time? So if you would do it all over again?
Yeah, easy. So this is what I've been speaking on. Every time I speak in front of a crowd these days, I end up talking about this topic. And that is my entire life. I started my career in real estate as like a DIYer. Right. I was painting, I was doing the plumbing, I was doing the roof, I was doing everything. And then at some point I kind of elevated my mindset up to more of a project manager level, which was more like, I'm going to hire my mother-in-law to answer phones. I'm going to hire a plumber to fix the toilet. I'm going to hire my wife to do the design work, or ask my wife to do the design work. So like, I was still like in it, but I was outsourcing the things I didn't really want to do. Then I feel like I elevated my mindset to another level at some point where I was more of like the COO. Like I was in charge. I had a team. I built employees underneath me. And then I was or more like I'm in the middle and I've got all these employees reporting to me and I'm making sure everyone's doing what they're doing. The biggest mindset shift in my career that I implemented at Open Door Capital was a 4th level of mindset that I don't think a lot of people ever even occurs to people that this exists. Because I think most people think that the top level is to be like a COO or CEO, like to be in charge. There's this 4th level I call the architect, right? That says like, it's my idea. I'm the energy. That made it a better word, the energy. Like I'm the energy behind the brand. I'm Kylie Jenner. I'm George Clooney to his tequila. I'm whatever, like these like celebrity names or that apply to business. They're like the energy behind it. So I was like, what if I built, and this was the question that just like, I stole it straight out of Tim Ferriss's 4-Hour Work Week. Like he says, if you had a gun to your head and you could only work 4 hours a week, how would you build your business? And so I asked the same thing. It's like, if I wanted to create a $50 million portfolio through syndication, but I wanted to work like an hour a week, what would I do? And the answer is I would do almost nothing. Like as the energy, my only job is to bring the energy. And so I hired, so most, and this kind of hopefully will sum up the answer to this. Most people they elevate from the bottom up. They do all the stuff themselves. Eventually they start kind of acting like a project manager in their business. And eventually they start acting like the boss, the COO that's running things. And then very rarely do you become like Richard Branson or whatever and try to like be the energy. So what I did is I flipped that upside down. This was the mindset shift that I realized is I don't have to build from the bottom up and learn how to do every single role on the way up. I could just start at the top and just say, I don't do anything. I'm going to hire a CEO. I'm going to hire an acquisitions person. Not that. I hired one person. I hired an integrator, a COO. Ryan in the beginning, Ryan Murdoch. And I was like, hey, go build me a company. Like, and then he did. Like, I'm like, it sounds like simple, but that's literally what I did. And there's obviously more drama that happens in there, but that was a mindset shift. Is you do not need to start at the bottom and grow over the course of many, many years. It's a mindset game. You can start at the highest level possible and just hire everyone else and hire someone else to build the company for you, as long as you can be the energy. So
And
it's
you
a long answer to a short
No,
question.
that was a great, and you reverse engineered that, right? Like, how are you going to pay the, well, first of all, you got a bunch of interns working for you for free, but you literally reverse engineered everything. It was like, hey, how much would I have to, how many acquisition fees would I need? How much of these, like to Francis' point earlier, that 2%, how much do I need to raise? How much do I need to acquire to get sufficient acquisition fees and asset management fees so I can go hire my team, right?
Yeah. So that actually was a story that like changed my mindset. I'll tell that real quick. Is when BiggerPockets sold a big chunk of it to a private equity, they brought in like this chairman of the board at BiggerPockets. And so we're meeting with this new chairman of the board, wicked smart, been in business for 50 years, like really like legit business guy. And we're telling him all the things that we have at BiggerPockets. We have 8 developers and we can do this with them. And we have this many marketing people. And here's how what we're going to do with it. And this many HR people, this is how many people we can hire because of that. And he finally holds up his hand and he says, guys, stop telling me what you have and what you can do with it. Tell me what's possible. Tell me what BiggerPockets can do. And then what you need to get there. We're just going to give you whatever you need to get to whatever that vision is. And for some reason, like that thought had never occurred to me. And so I wasn't thinking BiggerPockets, and I was already going, well, how do I apply this to real estate? I was like, okay, $50 million of real estate. I would have to have an acquisition. Like, what do I need to get there? If that's the goal, what do I need? Acquisitions. I need a assistant. I need investor relations. I need a COO to run the whole thing because I don't want to run the whole thing. And then I simply outlined the company structure. And then I just went and got those people, and that was it. Like, so I reverse engineered it from the end in mind, right? Stephen Covey, you start with the end in mind. This is what I think he means by it, is like, start with what the company looks like. What do you need to get there? Put those people in, and then manage them within a system that's easy to manage people, because I hate managing people. So we use EOS from the book Traction. And it just went. And the cool thing is anyone can do that. I don't want anyone going, oh, well, Brandon, yeah, he's got the podcast. He can get interns for free. If you've done 3 real estate deals in your entire life, you can get interns, because they're like, in the land of the blind, the one-eyed man is king, right? Like, if you've done a little bit, you're a hero, you're a god to tons of other people that are next to you that are like, oh, wow, they're a real estate investor. I want to learn from them. They will work for cheap, maybe not for free, because that's probably illegal unless they're doing no work. But you can get interns, you can get partners, you can JV, you can architect it from the top down and watch your business explode as well.
Love it. Love it. Great answer. Thanks, Brandon.
Thank you.
Sean,
You.
I'm going to go to you next. Though, Tony Castranovo, best beard on the planet. I agree. That's a great, the beard. Of course, you can never cut his beard off. Now that's the only challenge.
It would be beardless Brandon. I look like a 13-year-old girl when it's gone. It's really sad.
Sean White, you want to ask your question? Just unmute yourself.
Absolutely. First of all, it's great to be on this format and listening to Brandon talk a little bit. But for someone who's just kind of starting out from a syndication perspective, is coming from single family and smaller multifamily homes and has done a couple of passive investments and actually looking at some of the things Open Doors doing now, but that has goals of eventually starting their own syndication. Where would you say advice wise you would say to start in terms of, mentorship or just learning the ins and outs of really how to set up and establish a 506B the appropriate way from a syndication standpoint? And I'll stop there.
Yeah, man. I'll give a couple of different answers, but the first thought is like, setting up a syndication business was so much easier than I ever thought. Like, I had this great fear of how complicated it is, because in my world, I came from a DIY mentality. Like, I did all the stuff myself. So when I thought about all the things that had to be done to create a fund, it was almost overwhelming and scary. And then I realized the truth is you just pay Mauricio a bunch of money and he does all the work for you. It's kind of ridiculous. Because at this game, okay, so if you're a DIYer, you're flipping houses or whatever, we are constantly frustrated by crappy contractors, crappy title company people, crappy real estate agents. Everyone sucks. But once you get into the bigger game, most people are pretty smart and capable. And so you hire smart, capable people to do it. And they just do it for you. I mean, granted, again, I have people that do work in my teams, but you could as well. Like they do a lot of like the who's going to design your pitch deck and who's going to do that. But honestly, it's like you just hire someone to do the work for you, like Mauricio, and then he just makes it happen. It's one of those like, I love the analogy of you're driving down the road. I used to live in the Pacific Northwest. It was always foggy. Every morning was foggy. So I'd like drive to the gym at 5 a.m. or 6 a.m, super foggy. And I could not see down the road 2 miles. I couldn't see down the road 500 feet. So I don't know if there's a deer in the road. I don't know if the road turns. I don't know anything. But around my vehicle, there is a zone of clarity. You can always see 100 feet or so, even in fog. You can see a little bit. So as long as you keep moving forward, even if you have to go slow, but as long as you keep moving forward, you can always see a little further. And so that's how I look at anything. It's just like, well, I don't really know how to do a syndication. So I guess first step, I'm going to call Mauricio and ask him to set me up a 506B. All right. And then I'm like, okay, what do I do next? I got a little bit more clarity. I'm like, okay, well, I need to go out and, find a COO to run this, or I need to go and analyze some deals. I need to build a broker relationship. So you get this zone of clarity. And as long as you keep moving forward, I know that's a little more theoretical answer than a tactical one, but the encouragement I have is just to just do something that makes it go. And you will always see the next step as you get there. So there's never a point of going like, oh, I'm just completely stuck. I don't know what to do. There's always something you can do. And that leads to the next one. Does that answer that question?
I think so. Thank you.
All right. Yeah. One more thing to throw out there is like when I surround them, and this is obvious too, you want to be a better runner. You surround yourself with runners, right? If you want to be a Pokemon card player, just go hang out with a bunch of Pokemon card players, right? If you want to be a syndicator, like just hanging out with syndicators more often, going to conferences that are about syndication, reading books about syndication, that you just kind of naturally become that. To me, it's almost more of an identity issue than a tactical issue. Like what we need to do is shift your identity from I'm sitting on a couch to I'm a runner, right? Not that I want to be a runner, but I'm a runner. And once you believe I'm a runner, all of a sudden you start taking actions that runners do, even though you don't even know what those actions are. They just come to you because your identity says I'm a runner. So I think in a lot of ways, once your identity shifts to I'm a syndicator, because all my friends are syndicators or people I hang out with and I'm in a syndication class or I'm doing this, it just kind of goes. So again, two kind of theoretical things, but number one, just hire somebody and get the ball rolling on it. You'll figure out the next step.
Love it. Especially if you hire a really good integrator like Walker.
Yes. And I would argue that's probably the first step I would look for is like, how do you find somebody who is really good, who can then go and hire Mauricio? Like, how do you find the guy who's really good and then they're going to go out and do it? And they people like Walker was not experienced in syndication. I don't think Walker had ever bought a single real estate deal his entire life. I don't even know if he owned his own house when I hired him. He was a finance guy working at a public utility department, making like not even 6 figures, I don't think.
Yeah.
But yeah, he had the skill set needed. And I mean, he proved it through an internship. And that's why he's in charge today.
Yeah, that's great. Thanks, Brandon. Cindy, this is great because I actually forgot I was going to ask this at the top of the hour. I mean, obviously we've got, in the headlines is just everything about inflation and higher interest rates and all stuff. And then Cindy, you've got a great question about market conditions. You want to ask your question? Hi, Cindy.
Hi there. Thanks. You know what? I'm happy for you to frame that. But yes, I suppose I've just been an investor for about 3 years. So I know the market conditions are changing and it's very unpredictable the next few years. So just if you could speak into concerns, things to watch for and how you would adapt in maybe like something's coming around the corner would just be helpful.
Yeah. A few things there. So when I'm looking at the market in the future as where it's headed, right? First of all, we all know we don't have crystal balls. We can't see what's coming. But I like to use the analogy of like, I live in Hawaii, I live in Maui, and we get whales in whale season. It's like January, February, March, whale season. And one of our favorite activities, we call it whale hunting. We get on a paddle board and we paddle out to sea and we try to see if we can go see some whales up close and personal. Now, when we can do that because we see the whales at a distance and we can paddle. I could paddle to where the whales are, but then I'd miss them, right? So instead, what I'm doing is I'm paddling to where the whales are headed. I watch them for a little bit and I try to see where they're headed and I go and paddle there, right? It's like Wayne Gretzky once said, I don't skate to where the puck is, I skate to where the puck is going, right? So that's how I view all real estate investing in general is we need to always go and paddle to where the whales are going. And the more we study the whales and the more we study how fast they're moving and watch them, we can kind of get some idea. There's no guarantee that whale isn't going to change course. They do sometimes. But more often than not, I get really close to whales. I mean, I've got within a couple feet of whales. I've had them underneath me where I thought I was going to die. So in other words, like, because we're doing that work up front, we're going to see them. Now let me translate that to real estate. So there are trends that we see happening. There are whales moving that we see moving right now. One of them would be inflation, right? I think we all see inflation happening. Now, whether it's caused from the supply and demand, whether it's just the shutdown of COVID that caused problems, whether it's all the money we printed, you can argue that point, but it's clearly happening, right? So what does that mean? The whale I see moving is that rents are going to keep climbing until the government can get a handle on this. Rates are also going to be going up, and they're going to try to slow down the market. But if rents are going up and I can lock in debt right now, that is a whale I'm getting in front of right now. I have a hard time seeing how I'm going to screw that up. So, the few things that we're doing right now, long-term debt as much as possible, or we're buying like those rate caps. So it's basically like insurance on your loan. So that way the rate won't go up a certain amount over whatever you define. So you can buy, I don't know if it's technically insurance, but that's how it works, is you're buying a cap with a bunch of money up front. So we're doing that. So it de-risks us a little bit down the road. We're buying in markets where again, whales are headed, people are headed. So like we're buying in Austin, we're buying in, we're Atlanta, in Daytona. Like these markets are growing, and they're growing rapidly. There's a lot of job growth. There's a lot of energy behind them. I don't see that slowing down anytime soon. Furthermore, like I was looking at Austin the other day. Austin's got 165,000. What was it? Wait, no, 65,000 people a year, I think it is, moving there. And they're building right now, 2022, they have expected 20,000 units will come online. 65,000 people moving there, 20 units coming online. So what is that whale telling me? Like, what's that headed? It tells me that this market has a lot of room to continue going up. Now, could I be wrong on all these points? I definitely could be wrong on it, but again, I could be wrong on the whales. It just more often than not, it works out okay. So those are the things I'm looking for, is the rate caps, because I'm worried about interest rates going up. The markets, we're very specific on that. And then the last point is, we are very, very focused on a certain asset class or classes. Like we dove really deep in the mobile home parks. I believe we are one of the best mobile home park companies in the country. And that because of that, we're able to see opportunity, and should a collapse happen or something else, we're going to be able to figure our way out of it because we're so good at that asset class. Now we're also doing apartments, and we're partnering with a team in Texas who's really, really good at apartments. Like they're way better than I am at it, which is why I'm not doing it alone. I want to do it with the best, because at the end of the day, like an economy could shut down, but people who are the best, like the best in class people, they're going to figure out a way around it above everyone else, right? I don't need to be like, if I'm a contractor, as long as I'm in the top 10% of all contractors, I don't care if 80% of contractors go out of business. I'm in the top 10%. I'm still doing fine. So it's like those approaches is how I look at the economy. Could things shut down? Sure. Will it? Maybe. But we're preventing that as much as we can.
Yeah, I love it. Good stuff. And that's actually a great transition to Emma's question. Emma Powell, you're up next, because she's got some issues, not issues, but with the joint ventures as well. And I know I was about to mention that you're doing both, straight up syndications in your mobile home park funds, but then you're also joint venturing. So Emma, if you're still on, you want to ask a question about your, to use your word, your struggles.
Yeah, let's just call them issues. We know I have issues. So I'm really struggling with raising capital from limited partners, and could use some troubleshooting, because I feel like I do well on the joint ventures, but just being able to bring in more limited partners to my deal. I don't know if my list is too small, if I got the wrong people on my list, if I'm not nurturing or following up correctly. I know I interviewed on your podcast like last year, and I thought, oh, this is going to be fantastic, and I'm going to get so much credibility and so much low and trust, and I'm going to be able to raise money so much easier now. But it really hasn't really been easier. So I'm just really struggling figuring out which of these areas I'm falling down in and how to repair that.
Sure. A few thoughts come to mind. First of all, it could be any of those things, right? So I don't know if it's the list size or whatever. I tell you a few things. Number one, right now is harder to raise money than I've ever seen it before. I mean, I've been raising money now for 3 years. The last 2 months, especially, have been the most difficult I've seen. And I think that's primarily caused by, one, fear of recession. People want to hang on to money, but two, nobody wants to sell their stocks when stocks are down. Like, our followers are smart people. They're like, well, my stocks are down 40%. If I sell, I gotta, then it's real. So I'm going to hang on. But 3 months ago, stocks were at an all-time high. So they were selling left and right and dumping their money in the syndicator. So almost every syndicator I know is having similar problems with retail investors right now. And so just give yourself some grace for that. It is tough right now. That said, one, it's the constant the constant building of the list. So we're very focused. Again, we track our list every single day. We look at our numbers every single week. We have an EOS meeting where we're talking about our number on the list. We set a quarterly goal. It's one of the biggest company goals we have. We have 3 or 4 like rocks or like big company goals. And one of them is always list size. That's that important to me. So we track it. We're always thinking of new ways to grow it. Right now we're pouring heavily into like advertising for it because I think there's a lot of opportunity there. And you know, Mauricio, we've been talking about influencer marketing. Is there opportunities there? There's a lot of things because we focus so much on building the list. We start coming up with ideas and we're brainstorming all the time on how to do that better. So the first thing is what you focus on tends to improve. So we focus on that. When it comes to like the ongoing likability and trust, Instagram has been just phenomenal for that. I don't know how much work you put into Instagram, but you know, I say the story all the time, but I'll say it again now. And it's just like, I don't mean to pat myself on the back, but somebody once told me the reason they invest in Open Door Capital is because of how I talk about my wife online. And I love that statement because it shows that people are not investing in your deal. They're investing in your personality. They're investing in your character. And so social media is such an amazing way to showcase that. So like on my social media, you'll see, you know, me teaching real estate, which teaching is a great way to, you know, get people to like you. And then you'll see me dancing in the kitchen with my daughter, right? And then you'll see me on a date with my wife talking about goals. Those are true things that happen. All those things are true. I teach, I hang out with my kids and dance in the kitchen, and I go on dates with my wife. But I am also very intentional about putting those things on my Instagram because I'm calculated on that. I know that's what people like. I know that's how I develop deeper relationships. So I don't hide back on that stuff. I mix personal and business together on my stuff. So that's the nurturing. I've got the text message newsletter that goes out every week where I just pour out value. Like, this is what book that I'm reading. This is why I like it. This is a cool thing. I just bought it on Amazon. Like, I want to just people to think whenever they think of Brandon, I want them to think, hey, I like that guy. I like that guy. And then finally, we are very big on, I guess, a couple of things like simplifying what we do and using good marketing to communicate it. In other words, like, it's not just that we're a syndicator, we're a cash growth fund. A cash growth fund is a fund that provides both cash flow from really from quarter one, like right away. We don't buy properties that go negative, and opportunity for forced appreciation regardless of the market. Now that we call that a cash growth fund, little trademark sign next to it and everything. But you know what? What does that even mean? Like everyone's doing the same thing. You're doing the same thing. Like we're all doing the same thing, but I put a name on it. I made it simple to understand. And I talk about some syndicators out there don't have cash flow coming in for 5 years. So now there's like a bad guy out there, right? And I'm the good guy. They're the bad guy. So these are like little, like way that I position what we do to keep it simple. And the word I want you to remember is graspable. People need to grasp you. If there's one thing like I could impart about branding in general, is they have to be able to grasp your message and they have to be able to grasp you as a person. The beard is a very calculated choice that I made to become more graspable. Now, you don't have to grow a beard. It would be graspable. I mean, people would love that. But like, what I mean by that is when people like, they see me, I have something unique that stands out from everything else. And the beard is one way that I do it. I was just talking to my friend, Brittany Arneson, Investor Girl Brit. And she's like, that's exactly why I wear sparkly pants every time I go to an event. I wear these bright, shiny pants. It's graspable. Like people are like, oh yeah, the girl with the shiny pants. I remember her. The other day I was at a conference with a guy named Tony and we were talking about syndication. And I was like, I mean, he was a nice guy, but like we were talking about how do I make you memorable and graspable? And I was like, if I were you, I'd call my company Tony the Tiger Investor. And I'd brand everything like my investments are great. Like it's cheesy, right? But guess what? The next day I was up on stage talking to this group of people and I was like, yeah, like my friend Tony over here. I remembered Tony's name. I remembered the conversation with them. I remembered everything because I remembered Tony the Tiger. It became memorable and graspable. So like, and I mean, we could spend hours on that topic and I'll shut up now, but those are just a few things that I look at. The ongoing relationship, am I making my points graspable and am I graspable as a person? And then just the ongoing list and the nurturing of that. So I don't know if that gives you.
Yeah, it's great. That was a great word too. I never heard you use it before. That's great. Graspable. You did say something I was curious too, because you said something about just being a little bit harder these days to raise capital because of the stock market being down 40%. A lot of people, I'm super curious as to where you see, if we do get a little bit of a slowdown, everything's crashing, let alone slowing down. hasn't really hit real estate generally, although I know some markets are starting to ease up a little bit. Do you think it's going to be easier, harder? What are your thoughts on how I know you're going to be, if real estate softens a bit, you're going to be super excited. Things are going to be on sale, whatever, all that stuff. What about your investors? Are they going to be, is it going to be as easy to get that $100,000 check or $50,000 check if things get a little softer?
Yeah. I mean, I think that when things like during shifts, that's when everyone's afraid and pulls back and wants to just watch, right? So I think right now it is probably harder. I think it will likely get a little easier once we get some kind of stability. Yeah, at the same time, like it never feels stable. Like it always feels like unknown. So I don't know that to be true, but I like to think that it's going to get a little bit easier here as we level off a little bit, as when they stop raising rates on us every couple of weeks. You know, like when we get some stability, I think it will get easier. That said, like I said earlier, a lot of things are mechanical, right? So like, let's just say that 50% of my audience right now is no longer investing where we would have before. And like out of my huge list of accredited investors, half of them are no longer going to invest because they're nervous. And out of the ones that do, they're going to invest half as much. Now, I think that's pretty extreme, but let's just say that's the case. So what does that mean? It means I'm only able to raise 25% of what I could before. So some people look at that and go, well, shoot, we better do 25% less, or, 75% fewer deals or whatever. We better only do 25% of the deals we did last year to cover for that. And what I encourage my team to think, and other people around me, is no, ask yourself, how do we get 4 times as many people on our list? Like, how do I go from 1,000 people to 4,000 or 10,000 to 40,000? Like, how do we lean into it? And so by asking those questions, we start brainstorming, and we start, like, when I'm getting a massage or I'm sitting in the pool or I'm in the shower, like my mind is focused. The last month has been thinking of almost nothing else other than how do I quadruple my list? It's been consuming my every waking minute. My wife will just look at me sometime. I'm like staring off into space, and she's like, "You're thinking about it again." I'm like, "I know, I can't help it," right? Because it's a big problem that I'm trying to fix. And so, we're figuring out some really cool things right now, like stuff that I don't even want to talk about because they're so cool that they may work really well. They may just not work at all. But we've got so many cool ideas that we're playing with and we're testing right now. So when the market levels up, gets normal again, and everyone starts investing, what actually happens then? Now, let's say my list was 10,000 people, and I really did some work to be able to grow it way faster. And now I'm adding 4 times as many people to my list. And then the market gets normal again. Well, now all of a sudden I'm doing 4, 5, 10 times more real estate. In other words, hard times make good people, right? You've heard that before. Hard times make good people, or I think the phrase is hard times make good men make safe times make weak men, whatever that whole thing is. But like, we are getting better. We are up to bat right now at a baseball game, and we're holding 8 bats at one time, and they are heavy, and our muscles are getting really strong. And in a little bit, we're going to drop all those bats. We're going to have 1 baseball bat left, and we're going to be able to knock it out of the park way better. So I guess to summarize all that, when hard times hit like right now, this is opportunity to build some muscle. And so I'm excited about it. I'm pumped up for what we're doing, because it's going to make us a ridiculous amount of money in the future for us and our investors.
Love it. Love it. Do you ever use private money? I know Sukhdeep had that question. Do you recommend using private money or lending or hard money lending, especially at the beginning?
Oh yeah. Yeah. That's how I got my whole start, was private money, partnerships, and hard money. So like I would borrow from friends and family. There's definitely downsides of that, but yeah, I would do a lot of that. Like the main strategy I did for years to grow a lot of my early deals is I would find great properties that were going to be really good cash flow, good appreciation, all that I really felt good about. I would put together a really nice packet. And this actually goes back to the question earlier about having trouble raising money. There is such value in going above and beyond in how you present your deals. Like we are obsessed with making everything look and function really, really well. So, and I've always been that way. Like I really poured a lot of time into making my deals look good and to be graspable. I would then go to people and say, hey, I've got this ridiculously good real estate deal here that I'm trying to buy, but I don't have enough money to take it down. I'm looking for a partner. I wouldn't say the money part because that makes them scared. I just say, I'm looking for a partner who can bring in the capital, and then I do the rest, and we just split things down the road. Do you know anybody who would be interested in this? I love that question. Do you know anybody who would be interested in this? Because what does that do? It makes like them go, well, would I be interested in this? I think I would be. And then more often than not, they'd say, well, I'm interested. But I didn't have to like make it awkward with a family member or friend where like they have to feel like they're rejecting me. I would just give them the easy out, but I'd say, hey, do you know anybody? And every once in a while they'd say, no, I don't, Well, I'll think about it. Or, I don't really know anybody, but if somebody comes to mind, great. Either way, win-win. So yes, private money, hard money. I'm all about it. As long as you're safe, as long as you got all the T's crossed and I's dotted, it can be a great way to start building your rental portfolio.
That's awesome. Hey, Chris, Chris Collins is on. I saw it. This is kind of a large question, but I wanted to ask, I personally, because I'm actually pretty curious. Chris had such a great question in the community. I think it was last week, and I said I was going to answer it last week, but Chris, why don't you just ask it and see if we can just, I want to be respectful of Brandon's time. So, I mean, you could probably spend half hour on this, Brandon, but like maybe spend 30 seconds on it or something. But I'd love your thoughts because I'm actually curious. Chris, you had a great question about exiting a successful syndication company.
Yeah, we have to answer it in 30 seconds or less. So,
Go.
No, it's a perfect question for you because I feel like, especially in your talk with Mauricio before, you were talking about building a company versus a lot of people build kind of one or two people and you go and buy properties. You're building a company and a business, and a lot of businesses look to sell and exit and have that exit, exit multiplier. But when you have a syndication business, is there an exit, or do you just simply sell the next property and it's like, well, what are you going to sell? You don't have any more properties. You sold them all. Is there a bigger exit down the line?
Yeah, great question. So real estate is interesting, right? Because in reality, a syndication business is not actually a business. It's a bunch of little businesses, right? Each one's its own company. And so every company has a plan to eventually sell it. But as a whole, there is no like grand plan to eventually just sell the whole entire thing and sail from the sunset. That said, I do hold on probably like 20 or 30%, 40% hope. Or I think once I have 10, 15, 20,000 mobile home park units, like, actual pads, and I have a property management company, I think I'm going to be very popular. I'm going to be the hot girl to a lot of big hedge funds and private equity who's going to see that, and they may offer me a really low cap rate for just the whole thing. But if they do that, guess what I'm going to do the next week? I'm going to go out and buy more after that. So I don't see an end to that. I think it's an ongoing, there's always another deal down the road until I get bored. But the cool thing is, because I'm not actually doing much of the physical day-to-day, it's hard to get bored helping people like my team. It's hard to be bored of being like, hey, Walker, let me help you.
Yeah, and there's so many different assets too in a business, because it's not only just the asset, the actual property that you own, whatever that 20, 30% carried interest, but you've got a list that's super valuable. And what's Brandon's list worth? I mean, if you can get your hands on his list and he can hang out for a couple more years and be your consultant, that's got value. The brand has value. I mean, there's a lot of little mini pieces within the business that you could find value in.
Yeah, this is not a challenge to anybody, actually, but I did have the thought the other day. I was kind of doing a thought experiment with some friends, and I said, if my Instagram account got hacked today and it was impossible to get it back and they held it ransom, would I pay $1 million right now to get my Instagram account back? Yes, in a heartbeat. Would I pay 10 million to get my Instagram account back if it got hacked today? If I had 10 million lying around, like I would pay 10 million. That's how valuable that is to me. Like, would I pay 100 million? I might. It's like if I had that money, it's like, that's how valuable the brand is, because everything else can get wiped away, but the brand is so important. And when I say brand, I simply mean, this is how I define brand. When people think of you, what do they think about? Like, what do they think about when they think about you? That's what I mean by brand. And that's so powerful. And of course, Instagram is my biggest channel for brand, but it's not the only one.
Dude, we have excuse me, we have so many more questions, but I'm going to try and pick one more here because first of all, I wanted to appreciate, on behalf of everyone here, just super appreciative of your time. Before I go to the last question though, what's a good way for people to get in touch with you these days? Is it through the website? Is it for the Beardy, your text platform, which I love, by the way, I'm a member there too, a lot of great value. What's the best way people can get on your list and get more info now that you've disappeared from the BiggerPockets world?
I'm like a 13-year-old girl on Instagram. I'm on there every day. So Instagram, if you want to follow me personally, which I would recommend, Beardy Brandon, so Beard with a Y. And then if you want to know what we're doing at Open Door Capital, all the raise stuff, just go to ODC, Open Door Capital, ODCfund.com. We put the fun in fund. That's not our slogan, but I wish it was.
And you got nothing out there. I think you just sold out the last one, or do you have any room in the last one?
Of what?
Is it Sunbelt?
Yeah, Sunbelt. We sold out on Sunbelt, but now it's the whole thing of like getting to collect, right? Like anybody who's a syndicator knows, like you can collect 100, or you can get commitments for 100%, but let's call it 10 to 15% of people will change their mind at some point. So now we're at that phase where we're like taking people out and putting people in and just plugging all the holes. So definitely if somebody's interested in 3 awesome deals and 3 awesome submarkets that we're buying in, we can
hopefully they weren't going to use any of their Bitcoin to
that's we didn't even cover that, but yeah, that's another problem. People are selling their Bitcoin and investing with us. No more.
This will be the last one. Tim, if you're still on, Tim, I like this one about the choosing partners, because I know you've been doing that lately and getting into business relationships with another partner. Tim, you want to ask a question about that?
Yeah, sure. Hi, Brandon. Wanted to ask you a question. How do you recommend to choose the right partner? Do you look for certain traits and personality, or what's the process like?
Yeah, man.
What would you recommend?
It's similar to what I said about employees, but I'll expand a little bit. So when I said employees, like you never know how somebody's going to be until you work with them. So my very first my first partner at Open Door Capital was Ryan Murdoch. Today he's on the board with me. We like run it together in a lot of ways. But like I didn't know how Ryan brought a deal to me before Open Door Capital. I told everyone I wanted a 50-unit mobile home park. I didn't know Ryan, but he heard me say that at a meetup. He then found a 50-unit mobile home park and he brought it to me and said, "Hey man, I found a park for you." He was just trying to provide value to. And I was like, this is awesome. It is exactly what I want, but I don't know anything about Bangor, Maine. It was in Bangor, Maine. And so I said, "Ryan, do you want to partner on this deal with me?" And then he's like, "Oh, okay." I mean, I wasn't expecting that, but sure. And I said, "Okay, great. I'm hopping on a plane next week. I'm going to stay at your house." Like I literally said, I'm going to come stay at your house. He's like, "No, there's a lot of hotels here." I'm like, "I don't want a hotel. I'd rather stay with you." Awkward. Yes. But I needed to know, I wanted to partner with him, but I needed to know that could get along with him. So I wanted to stay at his house for that reason. But then we did one deal together and it was great. I saw how Ryan performed. And so what I was looking for is somebody who just executes. Like I'm a visionary. I can come up with a million ideas all day long. I'm the world's worst executor. I can't do anything. I'm like incompetent with all activities in the world. So like I needed somebody who just like, when I would say like, "Hey, I think we should do this," he would just go get it all done and have it done in a clean way. So for me, that complimented me as a visionary. He was my integrator. And then when it came time to start Open Door Capital, who do you think I went to? The guy I'd already done one deal with. So to summarize, I like to do a deal. And then I did another deal with him. Then we did a fund, just one fund. And then we started a company. So it took several interactions with Ryan to see how he was going to work and to make sure he was my complement before we brought him in. And then we brought in Brian Murray, and then we brought in other partners like Disrupt Equity. But yeah, we always want to see how they're going to be first. We always do a trial run. We always date before we get married.
And that's how you did it with Disrupt too. Like the first deal was structured, I think, a little bit differently than the ones you are now, because you wanted to see if it was going to work or not. And
yeah, the first deal doesn't matter. Like this is just for all real estate. The first deals don't matter. The only purpose of any first deal or 2 or 3 is to start building your identity and start building your network and to just like figure things out. So like, I don't care. Like I want my investors to make money, and they did. We sold our first fund and made a ton of money, but like, I don't care if I made a dime off that. That doesn't matter. What matters is that I get the experience and the networking, the connections, and we figure out if we work together well for future deals.
Brandon Turner, thank you so much for your time. I know you're a busy guy working 80 hours a week up there in Hawaii.
I'm gonna go scroll TikTok right now. I'm gonna sit on the couch for a little while. No,
I appreciate that. Kids. I know, yeah, you're gonna play in a big family guy. So again, on behalf of the entire real estate syndicator community, thanks so much, buddy, for stopping by, and look forward to speaking with you soon. Everybody, give him a round of applause.
Thank you all.
Thanks,
Appreciate
Brandon.
You all. Thank you.
Appreciate it, buddy. Thank you, man. Bye-bye.